There's always that kind of silver lining because at the same time, interest rates started to drop. Because you have to remember, way back then, rates were at like six and a quarter. There's different types of investors. If you're looking to buy your first home, if you're a single family, you're looking to buy a home, you're looking to move into it. I think house hacking is a great idea. Cost segregation has been around before bonus came into play, and it will be in play long after bonus goes away.
We were in negotiations. Investing in real estate, they're winning, they're making money.
What's up, everyone? Welcome to the Real Estate Educators Podcast, where we provide the education you can build on. I am your host, Kevin Amos. We're back with another amazing episode. I'm having so much fun doing this podcast, helping real estate investors and real estate educators. So, are you out there building a portfolio, flipping properties, buying rentals, or are you providing some content to other investors, maybe to market to them, try to get some business out of real estate investors? Well, this is the podcast for you. I have a super special guest with me, someone with over 2 decades of experience, Mr. Brian Kiczula. He is a background in mortgages and real estate, and then now he's doing a lot of cost seg studies. So we're going to learn a lot about that today. So, Brian, what's up, man? Welcome to the show.
Hey, thanks for having me on the episode. I'm stoked to be here.
So you're the founder of Cost Seg RX, but prior to that, you told me right before I hit record that you got quite a bit of experience in real estate. In fact, I think you got started somewhere around 2002, something like that.
Yeah, 2002 in San Diego, I jumped into real estate. Well, actually, it was in mortgages way back when. So in 2002 in San Diego, you had to have your real estate license in order to do mortgages. So I got a real estate license, and ultimately, I ended up working with a home builder in San Diego as a preferred lender. So that was my dream job. I thought I nailed it. So, a preferred lender, new home community, you
Yeah.
show up, and literally there was a line out the door of clients waiting for a thumbs up or a thumbs down because, the demand was just there. But as the years went on, 2007 rolled around and the market certainly changed. So, yeah, I've been at it for a long time.
So 2002, and you're the preferred lender for a home builder, and you're saying thumbs up or thumbs down. Brian, I got to tell you, I thought everything was thumbs up back then.
Uh, well, yeah. No income, no assets. Everybody knows the Nina loan. So yeah. So it was definitely that way to a certain extent, but you still had to qualify for the property more or
Yeah.
less to buy it. So sure.
Yeah, it was. I got started. Not. I was investing in real estate at that time, or right after that. I had my first one in 2003, actually. So I've been a landlord since then. But I ended up getting into the mortgages like you. But in Colorado, where I'm from, we didn't have any regulation at all. So for you guys, you had to be a realtor or a real estate
Yeah.
license to
Well, you
do
had
it.
to have your real estate license. And then in 2004, I got my real estate broker's license and I've had it ever since. But real estate, being transactional real estate was never something that I really did. I've done a number of deals, but that wasn't really my focus. So,
Okay.
yes. So we did have to have our license.
So then we moved to 2007, and this, for the listener, this is when interest rates started going up. Everybody was in adjustable rate loans, a lot of negative amortization, a lot of interest only. And it was sort of the start of the collapse, right? So what happened in 2007? You said it changed for you, or the environment changed. So how did it change for you?
Yeah, I mean, really in 2007, the market started to fall apart in San Diego. Well, not San Diego, but nationally. You look at banks like Countrywide or mortgage lenders like Countrywide, Greenpoint, so many others that were doing the no income, no asset loans. And when those mortgages started to go south, it really crushed the market. And it did for a long time for a part of the market, but there's always that kind of silver lining because at the same time, interest rates started to drop. Because you have to remember, way back then, rates were at like six and a quarter. So 6.25 was pretty normal for a mortgage rate, not at the 7% they're at right now. But rates came down to like 4.75. So we came off this really heavy purchase market. We moved into a solid refinance market. So it was one of those things that there was always a market. You just kind of had to shift what you were doing. So we went from the clients that were buying primarily, stated income to doing refinances for clients who had a ton of equity and had great jobs. They were working with, the technology companies in San Diego at the time. So yeah, interesting time.
Oh, I
Uh,
remember that time so clearly.
yeah.
There was this website. It was called like
The mortgage implode
the
is probably what.
I was going to say
Yeah.
bank implode, but yeah, it was a mortgage implode meter or something like
Yeah,
that.
yeah, that was it.
And
Yeah.
you could just look at it every day and see how many banks were just collapsing. It was quite remarkable.
Yeah, I'd say
Very
for
very
anybody who's
scary.
listening, definitely go to the Wayback Machine and look it up. It was interesting. Yeah.
Yeah, for sure. And if you guys are interested in learning more about what actually happened, because there's a lot of confusion, I think, for some people. Um, The Big Short, that movie, have you seen that?
Oh, yeah, absolutely.
Oh man, does that do a little confusing and hard to follow, but it does a great job walking through what actually happened there. So
Yeah, it's also great to rewatch. So, yeah.
yeah, yeah, exactly. You'll learn each time you
Because
watch
right
it.
now, I mean, there's, it's shifted again, and the markets have changed so many times over the years, and you don't really see it happening until you live through it, and you're like, "Oh god, I should have caught that coming." It's like right in your face. So, it's one of those
Exactly.
things as a real estate investor and being in the market is really keep your eyes open for the thing that, looks like the what is it, the golden ticket today, but you just have to pay attention to what's going on.
Yeah, and we've had quite the run since the 2008 crash. I mean, we
Oh yeah.
really haven't seen softening until just like right now, what we're experiencing, but we haven't seen any softening really since then.
No, I mean, we'll see. That's only because it's now everybody has to qualify for the loans for the most part.
Yeah,
There are the loans where you're buying based on the property's income or projected income, and that's not necessarily a bad thing. It's just you want to make sure that the loans are really well underwritten, so that if you're buying that property based on what you're projecting the income to be, that's sustainable in that market. Meaning, is there the employment base and everything else in that market to really push it forward? So,
that's a great point. So a lot of qualified loans out there on the bank's books and in the
mhm.
secondary market. So the chances of another 2008 are rather small. At least that's in my opinion of it.
Yeah,
Investors are somewhat nervous though, and being with your experience going through, like you got in right after the dot com crash, so you may have missed that a little bit, but I'm sure you had some exposure to it. And then the credit crisis, right? So really, you've gone through two pretty significant corrections.
yeah.
What are you seeing right now, and what kind of advice for an investor trying to get started?
Yeah, I would say, well, I mean, there's different types of investors. If you're looking to buy your first home, if you're a single family, you're looking to buy a home, you're looking to move into it. I think house hacking is a great idea. So if you can buy a property that has, 1 to 4 units and maybe fix up the second, third, and fourth unit, and then potentially rent those out and move into something else in the future, that's a real opportunity for someone who's starting or someone who's starting, look at a house that maybe has got, um, maybe you can build an ADU in the backyard. That's going on in California right now, and a lot of other areas in the country. And then if you're, let's say, a small residential investor, and you're looking to move up into, let's say, light industrial warehouses, what I'm seeing my clients do is same thing. They're looking to buy properties that have value adds, or they're looking to get into a syndication with a group of investors. Maybe they come in as a silent partner, and in that transaction, they know that they've got an extra acre of land that they can build another property. And we're seeing that. I was on another podcast recently, and they're doing that in Georgia, but with lots. So they're buying lots and then they're bringing in mobile homes. So they're creating opportunity. So I would say look for opportunities that allow you to, uh, you know, create other opportunities.
So keep your eye open for opportunities. And I think the one of the things that's beautiful about real estate is it's like you're there's no limit. Like however creative you can be, that's what's possible. And I think that's what I really enjoy about it.
I love it. So my thought with real estate, I mean, the different segments that you can get in. And, we're talking about my career as a mortgage lender primarily, starting in 2002. Well, fast forward to today, and I'm doing cost segregation studies. So there's so many avenues that you can, whether you're an investor, you're just actively involved, there's a lot of opportunities in real estate. Um, Yeah, so I would definitely say it's yeah, it's very interesting
Yeah,
niche to be part of.
let's get into the cost seg stuff because I mean there was a little risk there that that was going to go away, I believe, with some of the tax
Sure.
changes, and now it's back, and it's absolutely a phenomenal tool. So I want to get to know that a little bit, but typically you see cost segs in the commercial space.
Sure.
So I want to maybe start here, Brian. Explain to us what a cost segregation study is, why someone would do it, and then I want to ask you a couple of questions about the commercial space.
Sure, yeah, we can unpack it. And before we do, though, with cost segregation potentially going away, and what you were talking about was bonus depreciation specifically. Cost segregation has been around before bonus came into play, and it will be in play long after bonus goes away because it's helping you accelerate your depreciation. So that's really what we're doing. So you're asking, why would you do a cost segregation study or what is it? Well, the why is because it's allowing you to accelerate the depreciation on your property. So you're pulling forward your short life assets. So when I'm looking at a property, whether it's a smaller residential property or a 500 unit apartment complex, the first thing that I'm going to do is look at the exterior of the building. What I'm looking for is your driveways, your sidewalks, your landscaping, your swimming pools, your tennis courts, all of those, all of those items, your fence, all of the items that are outside the footprint of that primary building are land improvements. And most of them qualify as a 15-year asset. So a 15-year asset, you don't have to depreciate over 27 and a half or 39 years. So what we're doing is we're taking an asset that you're depreciating, you're writing down over 27 and a half or 39 years, and you're shortening that tax life to 15 years. Now, with bonus depreciation, let's make it simple. If it's 100% bonus depreciation, you can write off that entire asset in the first year. So let's say that, on I don't know, let's say it's $1 million basis on a property, and we find $100,000 in driveways, fences, pools, etc., which is pretty easy if you're starting to build out the exterior. You can take that $100,000 and you can offset $100,000 of income in year one. Now, the catch is it's either active income or passive income, and you really have to figure out which bucket it falls into because your income is going to be held in a silo: active income, passive income. So you want to make sure that you're able to use that depreciation. And I was talking about the exterior of the building, but same thing on the interior of the building. Your carpet is not a 27 and a half year asset or a 39-year asset, it's a 5-year asset. And the IRS will allow you to write that off over 5 years. So if you look at a number of items on the interior of a property, we might be able to pull forward a total of 20% of that asset. Well, let's call it realistically, maybe 10 to 25%, depending on the asset. Some assets are a lot higher percentage, but if you have $1 million in basis, and we're able to pull forward $200,000, it's pretty significant.
It can be very significant.
Mhm.
And we just talked, you just mentioned some things that are maybe a bit confusing to the listener because not all of our listeners are super experienced investors. So let's take a step back here, if we could, Brian, and help me understand depreciation. Because I always thought houses and real estate go up in value, appreciate.
Sure. So it's a paper loss. So you are writing down that property over a number of years. And whether you like it or not, you have to take depreciation on investment properties. You just don't have an option. If you don't and you sell the property, the IRS will assume you did, and you're still going to have to pay back the difference. So a little bit more complicated of a calculation, but yeah. So depreciation. So you're right. The value of your property may be going up every year, but the IRS is allowing you to depreciate it over time. So it helps offset your taxable income.
Right. So we often referred to as phantom loss. So if you hear the term phantom loss, that's just a paper loss, like Brian said, right? So it's not going to be out of your pocket, but it is going to benefit you on your tax return.
The other
Uh,
important piece to know is depreciation is a paper loss. So in the lending world, when the underwriters are looking to approve you for a loan, they're going to add that back. So let's say you have $100,000 in depreciation and you made $100,000 in income and you paid zero taxes. They're not going to say, hey, you only made $0. You're not going to qualify for the loan. They're going to add that back.
I'm
So
so glad you said that. That's something that is often confused. Even lenders, good lenders sometimes miss this. So if you don't understand that you're allowed to add back in paper losses and you're getting denied for a loan because you don't show income, this is something to look at. Sometimes you need to help your lender out.
that's very true.
Yeah, especially if they're newer. Okay, so depreciation, it's a commercial building, 39 and a half years. If you don't do a cost seg, if you do, some parts will be 5 years, some you could depreciate over 15. There's different times, different things you could depreciate it. And that's why we do the study. So help me understand exactly what a study is. Like, what do I get if I hire you to do a study? What do I get? How do I use that report? Help
Great.
me
So the
understand that.
first thing that I would do is you'd reach out to a cost segregation specialist, and I'm going to work up an estimate of benefits. A little bit of heavy lifting on the front end. So I'm going to look at the property. I'm going to work up an estimate of benefit showing you what I think we can accelerate on the property. Then I'll show you what I think your projected tax savings are. And then I'll say, hey, once you get the estimate from me, I recommend that you take it to your tax preparer or CPA to make sure it fits within your overall scenario. If you decide to engage and move forward, then we'll start the process. So, what we're going to do is a site inspection on the property, ideally, a physical site inspection. If it's a commercial property, certainly. If it's a smaller residential property, we might do a virtual site inspection. We still want a video walk through the property. We want to see the condition of all the assets. Then I'm going to take the findings back to our engineers and they're going to re engineer the building. What does that mean? It basically just means we're rebuilding your property using construction cost data. You know, how much is it going to cost to build a, I don't know, let's call it a just any type of property. Call it a 5,000 square foot Airbnb property. You know, it's got a swimming pool. It's got CMU block walls. It has asphalt shingle roofs. It's got, 3.5 ton HVAC system. We're going to rebuild all those components and then we're going to prorate it to what you actually bought the property for. And we're going to tell you what individual components we can carve out and accelerate into 5 year, 15, and 27.5 year property or 39-year property. So you're going to get a detailed engineering report back with a summary page that you can take to your CPA that will help you create your fixed asset schedule. And this is just so important as real estate investors, whether this is your first property or you own 100 properties, make sure to review the fixed asset schedule before you submit your taxes. And the reason why is because you want to make sure that your CPA is accurately credit for the assets that you acquired that year. I have seen time and time again where the CPA read the closing statement wrong and they listed the entire property, a $1.5 million purchase, as land. They didn't allocate anything to the building basis. The problem with that is land is a non depreciable asset. So that's a problem. So that's what we're doing. We're creating a detailed engineering study and we're giving your CPA what they need in order to set up their fixed asset schedules.
Yeah, when I'm listening to you tell this and the CPA just listing it all as land, and man, this sounds terrible. I just got to say it though. I don't know that they missed that. I feel like that's almost just being a little bit lazy.
I have a lot of respect for CPAs, and I know that they are overloaded at tax
Yeah,
season.
yes, they
So
are.
if you're trying to complete 300 studies and, you know, 300 tax returns within just a couple of months, you start dividing out the number of hours in a day, and you can see how they can miss things.
Yeah.
So I think
Okay.
I
Fair
think
enough.
as a property owner, you need to be your own advocate and review your tax returns before you sign them.
I also have respect for CPAs, and I see them make mistakes. Probably what you're saying. But I have found where if I'm not looking at what they're producing, or if they're not experienced in real estate, for example, it's not going to be right. I mean, oftentimes it's just not right. So I don't know why I'm saying this right now, Brian, honestly, but it just came to my mind when I heard you. That's a pretty significant mistake. So, the cost seg, of course, would prevent that, but just beware. Make sure you're working with CPAs that understand what you're trying to accomplish.
Yeah, and one of the things we can do is we can go back and instead of amending a prior year's tax returns, and we can do studies for clients who bought property 3 years ago and didn't do a cost segregation study. Or you can go back and correct mistakes on previously filed properties using the Form 3115. You're doing a change in accounting method and you're just correcting an error without having to amend a tax return. So just know that there are options to fix, things that are wrong.
That's good to know. I was actually going to ask you if you could do it after you've owned a property for a while. I think I've done three, maybe I think three cost seg studies, and they were all the same year I bought the building. So I
So
wasn't sure if you could go back, but that's good.
yeah, I recommend doing a study in the year that you acquire the property, 100%. But if you didn't and you're just finding out about cost segregation, then I would recommend that you look at, properties that you can go back and maybe do a study on. So you can do a look back study. It's no problem. Like I said, you just have to file the Form 3115 with your current year tax return. You're not amending a prior year's, you're just pulling forward any missed depreciation. I had a client call me yesterday. He has been renting a property out since 2016. He has never claimed any depreciation on the property,
Oh,
just found out about depreciation, not necessarily cost segregation. So I told him, you can go back and fix it. You don't even need to do the cost segregation study. You're just going to pull forward tens of thousands of dollars in missed depreciation that you can take this year. So, that could potentially write off all of his taxable income.
oh, that's significant. And this
Yeah.
is another reason why we want to work with professionals. Was this like a TurboTax kind of thing?
Uh, I won't answer that.
You're so conservative. um, okay, we'll let that one go. But yeah, again, to my point, work with competent professional help. Um,
Sure.
so CPAs are, I think, an absolute vital piece of your
You know,
team.
and I
And
think
I
that,
see people try to save money and they try to avoid it, right? And then this is what happens.
well, I think it's with anybody. It's, when you're working with somebody, I think personalized service uh, counts. You really want personalized service. You don't want to hire someone and
So is
their
H&R
response
Block
back
is
to
what.
you. Well, you don't want to get into a scenario or, a month like you're working with someone that you plan on having a long-term relationship with, and then they tell you that they don't have time for you because you're not their biggest client. Like I bill $500. I'm not saying I bill $500 an hour, but they say I bill $500 an hour to my highest clients, and I'm only making $500 on your transaction. I don't really have time for this. That's like a hard no. I don't even know. It's like, do you even respond or you just ghost them?
Right.
It's like you want people to give you personalized service, and that means, attention. So, yeah.
Yeah, I love that advice. This episode is brought to you by Pine Financial Group. Pine Financial is a private lender specializing in short term rehab lending to real estate investors. Got a property that needs some love? We can help. We are able to offer funding solutions because we raise private money from individual investors. With more than 15 years of experience, Pine offers passive investors an alternative that provides stability, consistency, and security to your portfolio. If you like real estate but want to avoid the ups and downs and effort, a Pine mortgage fund could be a perfect fit for you. Accredited investors will experience an 8% preferred return and profit sharing. Diversify your portfolio out of Wall Street and into Main Street with a Pine Financial Group mortgage fund. Get more information at pinefinancialgroup.com. That's pinefinancialgroup.com. Okay, so with the cost seg, I haven't seen it too often on the residential side, but you said just a minute ago that it's possible to do that. So what is there a limit? Like what type of properties can we do these studies on?
Yeah, I would say it just depends on your individual scenario. I've, done, small basis properties and, like you can buy a house for under $100,000 in Louisiana. There's places across the country where you can buy property for very low prices. I would say, send over if you were looking to get an estimate or a study done, Send it over. I'll work up the estimate of benefit and I'll send it back to you. And if it makes sense, then move forward. Ultimately, what it means to the owner of the property, are you going to see a return on investment? So residential studies are less expensive. They're typically under $1,000. Um, so are you going to see 10 times your return on that investment? The other piece that I don't know is maybe you're not as concerned about the depreciation on this one property, but you really need to drop your overall taxable income. Maybe you're meeting a certain threshold. I don't know that. So I would say send me any property. I'll look at it. We'll go over it together. If it makes sense, we'll move forward. If it doesn't, it doesn't. The other thing I don't know is maybe you're having me look at a property that you bought for $65,000. What I don't know is that maybe you own 200 of those. So all of a sudden, does it make sense to do it on that property? Maybe not. But when I look at the total of your portfolio, it absolutely does. So I would say get an estimate on any size property.
Okay, well, that's going to bring me to my next question here. Just curious if there's a reason I wouldn't do a cost seg study.
Yeah, there's lots of reasons you wouldn't do a cost segregation study. Or not a lot of reasons, a handful of studies. So, number one is when you're doing a study, and I mentioned it before, you have two types of income, whether it's active or passive. If you're stuck in that passive bucket, it's never going to go to active, and the straight line depreciation is meeting your needs, then you might not want to do a study. Although I could argue that you'd still want to do a study because your appliances and any equipment in your property is still a 5-year asset. So you'd want to set it up correctly on the front end. The other problem there is if you ever need to take dispositions on the asset. So let's say that 5 years in, you get hit with a hurricane, I don't know, and your roof rips off. I live in Florida, and you need that whole roof to be replaced. Your insurance company doesn't um, cover it. You could take a disposition on the roof if you had a study and take that loss in the year that you had it. Uh, Now let's get back again to the reasons you wouldn't do a study. Another reason why you wouldn't do a study is if you were just flipping the property. If you're flipping a property, that's strictly inventory. It's not an asset you can depreciate. So that'd be another reason. Or if you're really just looking to sell the property in a year or two, you might not want to do one because depreciation recapture is real. You're going to get hit with depreciation recapture, whether you're uh, selling a property that you did a cost segregation study on or not. The real difference, though, is your short life assets, the 1245 property, your personal property gets taxed at ordinary income rates. So if you make a gain on 1245 property, then you're going to get hit with ordinary income rates on it, which are much higher than capital gains. So those are the reasons I would recommend not doing a study.
Well, there's a lot to unpack there. We didn't talk about recapture. You mentioned it, you alluded to it earlier when you said you might have to repay the depreciation even if you didn't take it because it's required. But you didn't use the term recapture. So now that that's come up, let's talk about recapture. What is it? And then maybe if you could just briefly talk about the step up basis.
So let's say I'll deflect or defer on those questions. It does get a little bit more complicated. So I would say that
Just in general.
everything that I'm saying right now is for educational purposes only. It's very important that if you're looking at selling your property that you've been depreciating, you talk to your CPA first to see how that's going to impact you. Because whether you do a cost segregation study or not, you're going to have depreciation recapture. You're going to have to pay taxes on the gain that you make on that property. And what you don't want to do is you don't want to sell an asset without understanding what the exit looks like. Meaning, great, I made $100,000 on that property, but crap, I've got to pay $40,000 in taxes. So when it comes to depreciation recapture, it's important to know that it's there and you should run the calculations prior to selling an investment property so that you're properly disposing of that asset. And an opportunity would be to do a 1031 exchange. So you're exchanging a like kind property and you're buying another property. When it comes to the step up basis that you mentioned, again, educational purposes only, talk to your CPA about this, but typically what we're looking at when, I'm talking to clients about step up basis, it's inheriting a property. So it's getting the step up basis on the property, and that, is a great opportunity for someone to that inherits a commercial property or investment property to do a cost segregation study on it. And now you're getting you're getting the full value of the property to do the study on. So
Yeah. So where I was, I appreciate you deflecting a little bit there, Brian. So I'm just going to
yeah,
sort of say what's on my mind right now to try to
yeah,
help the listener. Everything you're saying, I agree with. The when you look at depreciation, what you're really doing is lowering a basis. And when you sell an asset, the gain that you pay is the difference between what you sold it for, and I'm making this simple, but what you sold it for and your basis. So as your basis is lowering, your capital gains increases. So that's what the depreciation is. Now, if you die and pass it to your heirs, that basis jumps to the current value as of today. So I didn't think about this. The Doing a new fresh cost seg study at that time when the basis jumps up makes total sense. But it's important to know that your all that depreciation you took will not be recaptured upon death. Your basis is now new, fresh, start all over, no taxes ever paid. I also like what you said about the 1031 because you could avoid, so you could defer. They want me, I should use the word defer, especially with you because you're very conservative. I could tell you're deferring the taxes on a 1031, so you're not going to have to recapture in that case either. So that's why I was getting at. And here, oh yeah, here's the important piece where I've seen people get in trouble, Brian. They don't understand the recapture, and then they depreciate, depreciate, depreciate. The basis is going down, 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 down. They keep refinancing because interest rates are doing whatever, and they need to pull some cash out. And all of a sudden, their house or their commercial building is an ATM machine, and then they owe so much more than they did when they bought it because they keep refinancing it. And then when they recapture all that depreciation, they might not even have enough proceeds after paying off the debt to meet that tax bill. So it can be a trap if we're not careful. So again, this is why we work with our CPAs and our professionals, but I have seen people get caught in that. So that's why I
and
wanted
that's
to mention it.
and that's the real phantom income piece that pops up. So, and what I've seen clients do, the workaround would be to buy another property and do a cost segregation
Yeah.
study on it. So you help wash out that tax liability. It's just it's really key to understand the disposition of your asset.
Yeah, that's a good point too. And one that I just recently learned. Instead of doing a 1031, it might make sense to just do a new cost seg. And that way you don't get confined to a certain time where you have to locate and close on an asset because that puts pressure on you and you might overpay. But what you just said is genius because you move it, you buy a new asset, do a cost seg, and you can wipe out a lot of that capital gain from the asset you sold. So another fantastic strategy. Okay, what else do we need to know about cost segregation and bonus depreciation, or is there anything else we should learn from you?
Yeah, I would say, fingers crossed, not everybody in the cost segregation industry is, you know, not everybody really likes bonus depreciation. Cost segregation has been around long before bonus depreciation. Again, I talked about it. You could take 100% of the short life assets. We've been it's been stepping down over the last couple of years, and it was going to phase out to zero, but it looks like it's coming back for tax year 2025. And I'm going to say fingers crossed, but if you're a real estate investor, fingers crossed that it goes through. And what it will mean is if you acquired an asset and placed it into service, meaning it was ready and available for its intended use on or after January 20th, 2025, then we're expecting bonus depreciation to get pushed forward for another 5 years at 100%. So that's it's not here yet, but it looks like it should be moving forward, which is great news.
Well, yeah, I agree with you. You listened to an episode you told me right before we hit record, so you know what's next. We're going to go through the notes on our episode. I learned a lot. Cost segregation is a pretty complex and complicated um, subject, so I think you did a great job, Ryan, of breaking this down for us and helping us understand depreciation, recapture, different lifespan, taxable life. Is that what you call it? Taxable life of different types of assets. So thank you for that. We started the episode going through your early career before you got into cost seg, and you were a realtor, but not really, more of a mortgage broker. You just needed that real estate license to transact business, and then 2007 made it a little bit tough for you, and eventually you moved over into the cost seg stuff. So, been in real estate for well over 2 decades. Um, I asked you, since you have so much experience, what advice would we can we learn from you? You said house hacking is a fantastic strategy. It's still working today. In fact, it probably works in every market. So you said house hacking is still working. You also like to value add commercial. You're seeing a lot of your clients do that. Maybe there's an extra lot. Maybe um, there's something with the property that can be improved, and we're seeing a lot of that in what I do as well. You also mentioned syndication, so bringing investors together and going after maybe larger projects. There's opportunities there. Always keep your eyes open. There's lots of creativity available in real estate, lots of different paths you could take. So keep your eyes open. Then we got into the cost seg stuff. Depreciation is a huge value add to a real estate investor. It helps you with your tax liabilities. The cost seg helps accelerate that. Always talk to your CPA. Take the estimate of benefit to your CPA before you do the study. And what I didn't ask you, Brian, is that free? Is that estimate of benefit? Is there a cost to that?
It's free. You just wanna like I said, it's a little bit heavy lifting on the front end, but I think it's well worth it.
Yep.
Do the upfront work. Yep.
So then once you have that estimate of benefit, then you will know sort of a return on the investment for the report, and you can work with Brian to decide whether you want to go ahead with the report or not. These reports are pretty intense, so they're not really that cheap, right? And maybe we could talk about that too. But then you said take it to the CPA. We talked about that. And then as far as CPAs go, you got a little defensive with me when I poked a jab at the CPAs. But you really like CPAs, and you said make sure that you are getting personal service. So not every CPA is right for every person. So let's just be careful there. Um, what I learned and I really liked is you can go back to prior years and make corrections. So if you didn't do a cost seg and you bought a building, you could still go back and take that depreciation and get some benefit today. And then we talked briefly about the step up basis and the 1031s and how to the overall tax strategy and how to legally pay as little taxes as possible. And that's all we're trying to do here, right? So, how did I do in those notes?
I think you nailed it.
Did I nail it? All right.
Unless this is a test.
We should have a test. I am going to test you here. I would like to get one more. Well, I want to get one more piece of advice. So I'm going to plant that seed. You think about that. And what can we learn from you right before we get off this call? But prior to that, talk to me a little bit about the studies. So if I bought, like, let's say a $2 million industrial building, there's a lot of people buying industrial right now. What kind of a cost would I expect for a study?
So I will give you the standard line that I think all cost
It
segregation
depends.
specialists will give you is it just depends on the scope of work. I mean, we're going to want to see the property and, you know, with commercial properties, they can vary so much, So the
Yep.
costs, like I said, small residential properties under $1,000. But industrial properties, think of, a 500 unit apartment complex or a 65,000 square foot, warehouse with multiple offices and, different businesses in it. It's just going to depend. That's why having that upfront estimate is so key.
Yeah. Okay, that's a fair answer. It is going to depend. I know but there's a lot of work that goes into these things. So I guess I'm just planting the seed to the listener. It's not going to be cheap, but it is worth it.
Yeah, it's worth looking at, and it should be free to get the estimate, so
Yeah.
and also have you don't wanna go onto a website and have them auto-generate an estimate. I had looked at creating one of those, but it's one of those things, garbage in, garbage out. You had asked if there's anything else, to learn, and the reason why it's garbage in, garbage out is because, guys, when you're doing a cost segregation study, one of the first things that I'm gonna look at is the cost basis, and then we've gotta look at the land allocation. We've got to come up with a clear understanding of what that land cost, remove it from the cost basis, and then we can look at doing the cost segregation study. So you really want to have your eyes on that when you're working on the estimate.
Yeah, that's a good point. And the easiest way for that I've seen to get the land value is just the county, but sometimes those are wrong. And it might actually make sense to have an appraiser's opinion, right?
I had one in LA. I just did an estimate of benefit on 2 days ago, and the county showed the land at 92.5% of the value of the
Right.
property.
Yeah.
So, I mean, I know that there is no way they could rebuild that property for, you know,
8% of what they paid for it.
exactly.
Yeah. No, I hear you. Okay. Your YouTube, you did put a YouTube channel here on my little intake form.
Yeah,
Can
I
you just
don't.
tell me a little bit about that?
Yeah, I wouldn't necessarily try to look me up on YouTube. I would always say just go to costsegrx.com, the website. So costsegrx.com. I do have a YouTube channel. I do put a lot of videos on my website and on YouTube, just talking about, the exciting world of cost segregation and, publication 946. So if need to go to sleep, jump on and watch it. It's certainly there, but the easiest way is just jump on the website or email me, Brian, Brian at costsegrx.com. So
All right, Brian. Well, I really appreciate your time, man. I did learn a lot. I know you made a joke about it being boring, taxes and cost segs. I actually really enjoy it. I think a dollar saved is more valuable than a dollar earned, and an easy way to save money is looking at your tax liability. So I actually enjoy it, but I know a lot of people may not. But in any case, thank you so much for your time. You gave me what 45 minutes or so, 40 minutes here, and I really do appreciate that. And for the listener, there's lots of different podcasts you could be listening to, and you chose to tune in to Real Estate Educators Podcast. I hope you got as much value out of this episode as I did. If you did, please 5-star review. That really helps us help more investors like you. And with that, I hope you make this day a great one. Thanks, Brian. Hey guys, I hope you enjoyed this episode as much as I did. If you did, please be sure to follow and leave us a review. Oh yeah, and tell a friend.